Hello and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra, the governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time.
Thank you. Thank you for the opportunity to be here.
So, first up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8 and the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than the current data which we have now only for Q1. Rightly you have said that it has come down. But how is it going to look like going ahead? And we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing that. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast therefore the outlook is lower, the growth is lower, certainly the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
Okay. So what you're saying is when you are looking at the neutral rate, it is not the current inflation minus repo rate minus current inflation. Will it be more repo rate minus 12-month forward inflation? Because in the MPC minutes, members are doing both. They're looking at current inflation. Some of them are looking at some points at 12-month forward. Where will your accent be?
See, your this real rate, first of all.
Yes.
It is the long run rate, interest rate, at which the economy is to be, in a neutral state or a state of equilibrium or a state of steadiness. Now, it's very difficult. First of all, it's very, very difficult to calculate this. It's not observed. It's an estimate, and it's a difficult thing to estimate.
Yes.
Even because you mentioned about this
Yes,
real
real rate.
real rate. So let's be very clear, that this is only a guidepost. This is not a precise number. Even in India, we have a range 1.4 to 1.9 or thereabouts. Even, in the US, they have a range. Each member, gives a very, very different estimate of this. And so John Williams, who's an authority in this, in fact, he says that, this is not a this star, the so-called star, is not a bright point of light, but it is a fuzzy blur. So it's imprecise, and it's moving, it's changing. So while that is important, it's only a guidepost. Coming to your question of
12-month forward.
12-month forward, or whether it is the current inflation, as I already mentioned, monetary policy is forward-looking. And so for us, what is more important is the inflation going forward. But inflation going forward, you don't know, I don't know.
No.
It's only an estimate.
Yes.
It's an outlook. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Okay, let me persist with this just for one last question. See, the inflation is likely to be around 3%, that is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So, I'm asking, when you say neutral, is it one-third hike, pause, cut? Or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI and
No,
stuff?
see, firstly, let me say that monetary policy, as I'm mentioning, it is forward-looking. At the point of time when the NPC met last in June,
Yeah.
the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's
Yes.
very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will
The
let you
average
know.
on the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards.
Okay.
And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. Well, sir, that's on the rate cut. Let me come to the VRRR, the liquidity issue. Now, when you do, what are the triggers you look at when you take the VRRR action? Do you want to only impact the call rate and ensure that the call rate is at least above SDF 5/4 to 5.5 range? Or do you want the TREPS market, which is, a very big interbank market where even mutual funds participate? 90% of the overnight exchange of money happens in the TREPS market. So will you target that also and want it to come to 5/4, or only you look at call rate?
See, the operating target for the monetary policy is very, very clear, which is the call money rate. And so we are looking only at that. We are not looking at the TREPS rate or the market repo rate or the collateralized money market rates. That's certainly not something that we are targeting. Of course, we look at it. I may also mention to you over here that these are although they are very, very different markets, because one of them is collateralized, other is non-collateralized, the other has, the participants are very, very different, right? Over here it's mostly in the non-collateralized market, it's the banks and the primary dealers, whereas over there you have the mutual funds, you have the insurers, provident funds, etc., etc. So they are very, very, although their composition is very, very different, they move in tandem. And we did an analysis, the coefficient of correlation between the two, both call money market rate and your market repo, 0.98. 0.98 is very, very high. Any economist will know that. And similarly, the TREPS rate and the call money rate is 0.98. Both of them. One is 0.977, the other is 0.983 for the last 1 year.
Yeah.
So they are very highly correlated. They move in tandem if we target. So it's really not material so much, I would say.
Okay.
If you target one, the other gets targeted on its own.
Okay.
And it's not true, only for the non-collateralized market, even for the CP, CE, Treasury, and so on, the whole spectrum of the money market. So that's how, we are looking at
which rate to target, which is your call.
Yes.
Which is your call rate. Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate? As you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly, within the corridor, which at present is 5 quarters to 3 quarters. And while we would like it to be, at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well. On new loans, there is a 24 basis points of transmission already till May. We have data only till May.
Yeah.
Which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning unit was 544, so it's quite close.
Yes.
Friday it closed at 545. And so our effort will be to, while, maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Okay, it should help you.
These are the two factors which will continue to guide us.
Okay. No, it's fair that, transmission is a very important instrument, and you have the freedom from 5 quarter to, 575. But would you say we are still in early stages transmission?
Yes, of course. Because, see, when I said May, I have figures till May, that's only 3 months. And in June, we cut by 50 basis points. So there's a long journey, yet. 100 basis points. As against 100 basis points, it's still, I do not have the figures for June, but till May it was 24 basis points. My sense is that it has, of course, improved, but there is still distance for us to cover over there.
Just a final question on this repo call rate thing. When will the liquidity framework be published? Because the market is very anxious as to what rates.
There is an internal working group which was constituted. They have had extensive consultations with various stakeholders, banks, economists, etc., etc. There are multiple views, as with multiple stakeholders, with divergent interests, which is.
So when does it come out, you think?
As I mentioned to you, it's not such a major issue.
Okay. No, I'll tell
As
you why.
I said,
because
it's not a major issue because As I mentioned to you, the call money, one of the important issues that this internal working group is actually deliberating upon is that what should be the operating target.
Yes.
As I mentioned to you, they move in tandem. They are very, very highly correlated. So that's really not a major issue, even though, as you are saying, the volumes are less, but the impact is, throughout the spectrum. So that's not, the report should be out, by the, I think, by the end of this month, we should have the report out. I do not expect major changes. We are trying, of course, to increase volumes in the call money market. We extended, the times for the markets.
Yes.
Made some improvement. We'll see how, we can further improve these markets. Let me emphasize that these are two different segments with two very different regulatory regimes. Some of them, we don't even regulate. And so, we need to keep that in mind when these questions are actually
in any
addressed.
case, as you say, the coefficient correlation is very high.
Yes.
Now let me come to the other big announcement you made on CRR, the big CRR cut. What is the trigger? Was it that our current account deficit is now under 1%, so we won't need so much money for intervention like we needed during Lehman crisis and all that? Or is it more because there is a lot of LCR? What's the trigger?
See, first of all, it's not a prudential tool. So LCR, is more of a prudential tool, right? It's not a liquidity tool. It's a liquidity tool for the banks.
Yes.
Not a liquidity tool for the system as a whole. You understand that, and so would your viewers. So it's more, of a monetary policy tool for the liquidity management of the system. Now you are aware, it used to be very high, 15% and all. 2006, we had this amendment in the Act. It's now, and then, later on it was brought down in 2013 to 3%, to 4%, sorry. Earlier we used to give an interest. And post the amendment, there is no interest. Interest has a bearing, because if you pay in interest, then you can have a higher CRR. The effectiveness of the CRR, however, decreases if you have the payment of an interest. And so that's why gradually, post 2006, it was brought down to 4%. 2013 to 2025, we have decreased it a few times, but never below 3%. So we have used only
very sparingly.
Not only very sparingly, the amount is only 1%. The ammunition that we have is 4%. We can pass on, 4%.
Yeah.
I can always withdraw as much as I want, from 4% to 5, 6, there is no ceiling. But the amount that I can give, because I can't go in a negative zone and start, which also I can, in fact, I can start giving money, right? So I can go in a negative zone. But assuming that, I don't go into a negative terrain, I have the 4% cushion, which lasts 12, 13 years. Including COVID, we have used only 1%. So, and it has a cost. As you are aware, it has a cost, and the cost is not only on the bank intermediary, it gets passed on to the depositors and to your borrowers. And so, while, we have provided this certainty, you can always ask us, as to why we did it now. If we had to actually implement it from September onwards, why we did it now. But that was only, as we have been saying, we have been preemptive, we have been, so that, it gives us, in these uncertain times, to our banks, a little more certainty to plan things out. And so that is the new kind of a normal, that I was talking about.
Ownership of banks. You said that there is a review. Personally, what is your opinion? Would you want at some point conglomerates also to have banking licenses?
This is a very, very old question. This is a very...
It doesn't go out of fashion, sir.
Yeah.
Or out of the desires of conglomerates.
Yeah, so I think this question primarily comes from the fact that some of the corporate groups, they have deep pockets. And the banking industry, at the same time, needs capital, whether it is the existing banks or whether it is the new banks. So that's certainly a valid question, but at the same time, let's also keep in mind that conducting business, financial business, and real economic activities within the same group has a conflict of interest.
See.
And I would say that this counter argument is equally valid and equally relevant even today.
Okay, you were talking about that you will review bank ownership rules more in the instance of.
Yes, we are of course reviewing it and seeing as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks. How we can change some of these, the foreign banks. How we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really.
Yes.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So, what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So, as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%.
Yes.
All right. And the foreign banks can actually start business in our country
100%.
as even up to 100%.
Yes.
So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%.
Okay.
So if you don't allow them even 26%,
yeah,
that kind of seems to defy logic.
Yeah. Fair enough.
So we will be okay in allowing them, or whether it is on a case-to-case basis, whether it is as a general matter of policy. These are matters of detail, which we'll work out.
Okay. Fine. Now let me come to small finance banks, which you already alluded to. You have eased the priority sector requirements from the earlier 60% to 40, from 75 to 60%. Will you see more reason to ease the rules further?
Yeah, we change. See, small finance banks can actually transition to the universal banks. And so this change that we did was primarily because the PSL targets requirements for universal banks at 40% was a huge difference. And so that would certainly have impeded their diversification and their transition into universal banks. We consider the small finance banks as nurseries for universal banks, and it will certainly be our endeavor to provide them the right climate, the right regulatory regime, so that they not only grow as small finance banks, but they graduate into universal banks. Our regulations are not fixed in time. They are not frozen in time.
Yeah.
We keep evolving, we keep changing with the times. We have come out with a, you are aware, with a regulation making framework where we have said that we'll be reviewing each and every regulation every 5 to 7 years.
Yes.
Of course, we do it continuously, but as a practice, every 5 to 7 years, each and every regulation, so that we are aligned, with the times. So that is something which is applicable even for the small finance
For
banks.
finance banks as well. Okay, more generally, if you look at banks, they have a lot of obligations. They have SLR obligations or LCR obligations. They have PSL, a priority sector, and then they have CRR, which was all okay. All this is a cost to the banks, which was okay when they were the king of all the savings. My father saved only in FDs, and perhaps that would be true of your father. But increasingly, mutual funds have become far more attractive for the savers. So will you consider even more of the constraints on banks need to be removed, giving them more of a commercial chance?
No, see, as I mentioned to you,
You removed CRR by 1 percentage point, but
not only CRR, we also changed priority sector lending guidelines that will help them. And over a period of time, changes have happened for the whole regulated space, not only banks, even the NBFCs, etc. All these, as you are mentioning, they have a purpose. It's not, that they are not without a purpose.
No, they all have it.
They all have a purpose,
Either prudential or...
Either prudential or liquidity or, stability or a socio-economic purpose, like the priority sector loans. But we do recognize, as you are mentioning, that they have also costs at the same time. And as I have, and these are trade-offs. So these trade-offs we have to balance.
Yes.
And we have been doing this. RBI has been, doing this. Yosef mentioned CRR was reduced, LCR, was amended to
tweaked.
Yes. was tweaked. SLR was brought down. It used to be very high, 18%. Now it's only perhaps lost its relevance to an extent. Right?
Yeah, it's become LCR.
So RBI has been very nimble-footed. We have always kept in mind and try to balance these trade-offs. As I mentioned, we have now come out with a regulation-making framework. We'll continue to be nimble-footed. We'll continue to assess and analyze the evolving and the changing needs of the economy. I do get your point, that costs on the banks, especially, because these deposits earlier used to be quite high. In fact, last 9 years, from 43% savings, which used to go into the banks, from 43% they have come down to 35%. So that's a change of, in every year, if it is going to reduce almost by 1%, and others, shares, etc., small savings, shares, debentures, mutual funds, they have gained shares. So these are certainly to be kept in mind while we make our regulations. Our regulations have to be proportionate, to the purpose that is there, and we will continue to do so. As I mentioned, we are now, first of all, consolidating all our regulations. We came out with a Citizens Charter. We revised the Citizens Charter. Of course, not much was mentioned about it, and we also, didn't publicize it too much, but we have revised our Citizens Charter. We are now consolidating all our regulations. There are some thousands of regulations, We are consolidating into a few regulations so that all of them are in place. And more importantly, we will be reviewing all our regulations so that we are able to provide to all our regulated entities, not only the banks, but also the NBFCs and other payment banks, payment system operators, all our regulated entities, a competitive, so that they are competitive.
No, I'll tell you more than competition, because the banks are seeing a fall in term deposits. That kind of money is going to mutual funds. They are hesitating for long-term investments altogether. I mean, it's not that too many infra projects have come, but they will be unable or unwilling because of the ALM mismatch, and they will become only retail lenders. Many of them have become increasingly retail. Is that a problem for you, or, the infrastructure will be financed by PFC, REC, NABFID, etc., and you're okay with banks becoming retail lenders only, largely?
No. See, infrastructure is certainly a priority for the government and for the Reserve Bank. Our country needs more and more of infrastructure. We are still, in a phase of development, and infrastructure is the foundation on which any economic activity can be done. So that's very important. We will certainly like that the banks continue to do infrastructure lending. The government has increased its resources for capex.
Yes.
And so would we like, I think over the last few years, infrastructure spending by banks has increased.
It's not much, sir. It's like, most of them have become retail banks. So
you are right that the share of retail has increased. Certainly, you are correct. The share of retail has increased. The point I was making is that infrastructure has also increased, maybe not in same proportion.
Aggregate.
But that you see even in large industrial loans, that has there is a lower growth of bank credit, about 5%, and similarly, infrastructure is also about 5%.
Yeah.
Now, one of the reasons is, of course, that there have now, alternative means of funding them. We have now the InvITs. So
Yes.
Some of it is being funded by the InvITs. We came up, with a development financial institution primarily for infrastructures. We have the NABFID, corporate bonds. Again, they are also gaining traction.
Yes.
So, and banks are also contributing. We have taken a number of steps. You are aware, infrastructure bonds can be raised, for
provisioning
infrastructure.
is lower.
Project finance, again, we have harmonized, the project financing guidelines, and we will continue to push infrastructure.
No, it's just that because of the ALM, because you're getting short-term money, we are preferring retail. That's why I asked you. Let me come to the final growth picture that you have. The e-way bills have dropped a bit. GST collections in May was excellent. June was unimpressive. Car sales are unimpressive. And the global uncertainty is not going away at all, if anything, compounding. Would you worry about growth at this juncture? Is this 6.5 also possible?
Well, that's 6.5, is our latest number. Yes, there are mixed signals, high frequency indicators, more or less, they are aligned with our projections. We'll again, revise them in case needed. We will again reassess them, review them for our monetary policy, which is due in another 15-20 days. Urban, yes, you're right. Air traffic is subdued. Passenger cars are again, that is subdued. FMCG sales, of course, are doing well in the urban areas as well. There is robust growth of consumption in rural areas.
Yes.
Monsoon is favorable.
Yes.
We are hopeful of, a good trade deal. Hopefully, that's in the final stages. Let's see. Let's keep our fingers crossed over there. There is good optimism that we see in our surveys of consumer surveys that we see. We'll again reassess the situation on the growth front going forward.
Well, just two topical topics, brief ones. The finance minister, while speaking to NBFC, said that she wants them to become, 50% partners in funding by 2030 or so. But, RBI's upper level compliance for NBFCs is fairly rigorous. And maybe with good reason. I mean, when you're upper level, upper tier, you're like, prominent. Will you all do anything for them, considering that the finance minister wants them to have a much bigger role?
We would like everyone to have a bigger role. And whatever is needed for, as I mentioned even earlier, not only for the banks, but also for the NBFCs, payment system operators, and so on and so forth, for all of them, and even for the economy, even those which we don't regulate.
Yeah.
The overall objective is that India grows. We are at a critical juncture, Viksit Bharat by 2047, and we'll play our role, whatever is required, keeping in mind the aspirational goals of India, and not only of the banks or the NBFCs, but everyone.
Okay. Just the final question is, because there is this law that is sitting in front of the US House of Representatives, crypto law, in fact they're calling it crypto.
I think it got passed recently.
Yeah. So I was just wondering if in the Reserve Bank any chatter on this. Reserve Bank was opposed to it, and I thought with very good reason, but
See,
when you re-look, because the world is moving.
there is, I would not like to talk about it, because there is a group already constituted by the Government of India, headed by the Secretary. We are also represented over there. We have given our views. It has implications for monetary policy and financial stability, as we have already mentioned. I may also mention, see, that the landscape here for payments in India is very, very different.
Yes.
A lot of the issues which are there in some of the other economies, we have been able to resolve, because we have the UPI, we have the NEFT, we have the RTGS. The problem is basically for small payments, costs of small payments in these other countries and cross-border payments are high. We have been able to resolve it. So let's wait for the final recommendations of the working group.
Okay, thank you very much, Governor, for your time. I just wanted to ask you one personal question. You landed in at a time when things were quite tense for the economy. I mean, the election in the US had made things a little difficult for the economy, uncertain for the economy. What was your learning curve as a central banker? I mean, usually when you come as a DEA secretary and then you already had one foot in. But you came, Revenue Secretary is not part of the board. So what was your learning curve like?
No, first of all, it's an honor, to be here. It's a challenging one, as you are saying, but at the same time, it's an honor. It's a very revered institution, and so it's a prestigious for me, to be heading this organization. We have a good, very good professional team. We in the IAS, of course, you are aware, we move. Yes. We move, from sector to sector, which are very, very diverse. And
no,
so
I would argue that is useful as a governor, because you all have seen a large part of the economy. But in 6 months to learn so much.
So that's the point I'm making, that when we move, I'm not saying, because we move, so we have a lot of experience. The point I was making is that because we move from one sector to another sector, there is always, a learning curve over there. Some will have a steep learning curve, some will have less learning curve. So without naming, sectors which had a steeper learning curve, but each so that gives you, that kind of experience, to how to handle, and how to learn going into a new organization. Having said that, of course, I've had experience, I was the banking secretary for some time. I've headed an NBFC, one of the largest NBFCs in the country. That helped me. My course, in Princeton, I did a monetary policy course there with Alan Blinder over there. So that, helped me. And we have a very good team over here, which supports us. I am hopeful, that I'll be able to do my bit in these challenging times.
Okay, if Alan Blinder was a teacher, then you've already been coached very well in the theoretical foundations. Thank you very much,
my pleasure,
Governor, for spending time with us. And I'm sure you've answered a lot of queries that economy and the markets had. Thank you very much for your time.
Thank you. It's been my pleasure.